And what we did, we recorded few transactions in here. So we we sold common stock to shareholders for collection of $350,000 equity financing, total cash collected. And that's the journal entry. We purchased an equipment, which we need to do depreciation later on at the end of the year. We paid some utility bills. We also paid in advance for rent. We received $65,000 advance payment from a customer to provide some type of service, whatever we do. And also the board of directors, they declared dividend for $22,000. So we record all those journal entries by doing journal entry and then save it or post it into T accounts. Okay, and then whatever it was in the T account, all these balances has been transferred to worksheet in here. You see all of them are transferred from T accounts. And here in worksheet, we are trying to see kind of brainstorming to see what type of adjustments we need to do before we actually start doing it. Because doing adjustments is not a big deal. But what we need to do, how much we need to do, that's the problem. That can be easily be mistaken, and the mistake in accounting is not acceptable. It gives us a lot of headache later on. So it's better to, do it right from the beginning. So therefore, we create a worksheet. This is a plan of action. This is planning. This is not doing anything yet, just planning. What type of adjustments at the end of the year the company needs to be aware of and needs to do in order to prepare a reliable financial statements like income statement and balance sheet. And again, this is just a planning right now. So all my trial balances I entered here by copying from the first page from the T accounts, and the balances are equal on both sides. So I'm pretty much okay. And what we did now after this, we said, okay, prepaid rent, half of it is expired because that was for 2 years. So we need to recognize rent expense for the 12 months that has been used. And that will be half of 36,000, which is 18,000. So that's the $18,000. The original balance is obviously debit, it's an asset. So we do opposite of it, credit, in order to reduce it and to be end up with $18,000 on adjusted trial balance right there. So 36 debit, less 18 credit, definitely the answer will be 18 debit left for the next year. In regards to 18,000 credit, you don't forget you have $18,000 debit in here, which is rent expense. For equipment, we recognize that equipment needs to be depreciated. We use it for the last 12 months. So 1 year of equipment needs to be depreciated and to be recognized as an expense. And in order to do that, we calculated that somewhere, I believe. Did we? Yes. So here we go. We said 48,000 less $3,000 salvage value or residual value that you will be able to sell it after 10 years of useful life. So let's deduct that. So 48 minus 3, the 3,000 you will receive it at the end anyway, right? Hopefully. So those are all estimated anyway. So we say 3,000 estimated salvage value. We deduct it from 48. It becomes $45,000 depreciable amount. Depreciable amount divided by 10 years useful life, it gives you annual depreciation of $4,500 a year to be depreciated. And since we bought this equipment exactly 12 months ago at the beginning of the year, January, so 4,500 times 12 divided by 12, 12 over 12, it's still 4,500. If you bought it just 3 months ago, you see 4,500 times 3 over 12, 3 divided by 12. But in this case, it's just 12 months, so 4,500 times 12 divided by 12, that will give you exactly $4,500. Okay, so there you go. In here, we do not credit equipment. You see, equipment is debit. We keep it the way it is, just to show that equipment original cost is $48,000 in the balance sheet. And people can see it. So they know original we paid 48, but we create a sub account. It's a contra account to equipment, it's just right next to it. And we call it accumulated depreciation dash equipment. So this is a contra account to equipment. So anything happens to the contra account, it means happened to the actual account. So $4,500 will be credited in here. So we don't credit equipment, but we credit accumulated depreciation. And because that's a credit, therefore we need to have a debit. And we call that depreciation expense dash equipment. Okay, so the next one was in regards to unearned revenue. When we have an unearned revenue, prepaid cash by customer to provide a service in future. The other name is deferred revenue. That means you deferred the recognition of revenue. So you say, okay, $65,000, but let's talk to management to see what's going on. And in line 6, page 1, here we talk to management, and they say that the unearned revenue balance at this moment, as of December 31st of 2014, is just $2,000. And we say, oh, okay, perfect. So let's go to worksheet, and we say 65 minus 2, that means I have to adjust $63,000. Okay? We adjust $63,000. This is a credit, obviously, it's a liability. We do the opposite to adjust it, so it's a debit. And the result will be remaining $2,000, which is exactly what the management said. But because this is a debit, obviously we need a credit also, and that credit will be revenue. You might call any type of revenue you like, but bottom line, it's a revenue. So if you add them up, you see it's both sides equal, 85,500, 85,500, debit side and credit side. So my suggested adjustments looks good. We talked to our accounting team, like in a meeting, to make sure all these are good and we didn't miss anything else. So in the meeting, we have management, operating management, accounting staff, and we discussed this. and we make sure that there is nothing forgotten for any reason. And everyone says, no, I don't think anything else is necessary to adjust. We don't have wage expense to adjust. We don't have interest payable to adjust. We don't have accounts payable to adjust. We don't have supplies, so don't worry about adjustments on that. We didn't do any job recently that we need to invoice them, so there's no accounts receivable to adjust. So it looks like this is it. We say, okay, let's create this adjusted trial balance. So 319 goes on the other side. This is 36 debit, 18 credit. The answer will be 18 debit. 48, there is nothing to adjust anyway, so it goes over there. And there's nothing in here, so 0 plus 45 is 45. 22 will just be transferred over there. But here we have adjustment, so 65 credit less 63 debit ends up in here with $2,000 balance, and that's the formula. And common stock will be transferred, dividend will be transferred, revenue will be transferred on the other side, depreciation expense will be transferred, utility expense and rent expense will be transferred. After we transfer everything properly, we check the balances, and voila, life is good. Both sides are equal. So looks like we are in a good shape so far, so good. Any question for me? Let me know. Okay, so now that we are done, let's talk about these adjustments a little bit further. We have two types of adjustments, the main type of adjustments that we call it deferral adjustment and accrual adjustment. So let me type it here, let's say. Deferral, I believe maybe 2R. And the other one is accrual adjustments. So what's the difference? Deferral adjustments are adjustments that we received or paid cash in advance, and now we need and we deferred the recognition of revenue or expense to future. Okay, so this is what deferral adjustment is. So deferral adjustment is an adjustment So deferral adjustment is an adjustment that it's in regards to a cash either received or paid in advance, and we deferred the recognition and we received or paid cash in advance, and we deferred the recognition of revenue or expense to future, which is end of the year. Make sense? So an example maybe I can have here. Let's say here, we paid, you see prepaid rent, we paid cash in advance and we deferred the recognition of expense to future. And future is now at the end of the year. Or here, we, let's say, here, we received cash in advance and we deferred, we call it deferral revenue or unearned revenue. And we deferred revenue, recognition of revenue to future, which is now end of the year, and we're gonna recognize proper amount of revenue. So that's what deferral adjustment is. So that's a deferral adjustment. Accrual adjustment is no cash paid or received. So no cash paid or received. However, something happened or accrued because of passage of time, let's say. So something accrued here. No cash paid or received. However, something happened or accrued because of passage of time. An example that here I can say kind of it's related to that is equipment. You see, when you have equipment, you might say, oh, okay, passage of time, so we use the equipment and now we have to recognize a proper amount of expense. The other example is, I don't have it here, but let's say you, many years ago, you borrow money or you purchase a home or something, and you have a note payable or a mortgage payable, and that mortgage or note now is accumulating interest that you need to pay. So you have a liability, we call it interest payable. So because you borrow money sometime in past or bought something in past, let's say truck or something. So that interest is now due and you need to, because of passage of time, so the interest now is due and you need to calculate how much the interest is due so you can pay that interest. So in order to calculate, let's say, interest, you will say the interest principal, the liability principal that you borrow, let's say $100,000. And passage of time, how many months passed? Let's say 6 months ago. So you say, and how much is the interest rate? Let's say 10%. So 10% times $100,000 principal, that will be $10,000. But you borrow that, let's say, or for some reason, that was 6 months ago. So $10,000 times 6 out of 12, 6 divided by 12, and that will become $5,000 interest payable. And here you record, here, credit interest payable. No, which one? This one. Credit interest payable, right? And here you say debit interest expense. And that's an accrual adjustment. So at the end of the year, companies they have two types of adjustments to do. Either accrual adjustments or deferral adjustments. Okay, and we got a few examples here just to warm up. Okay, so the next step is preparing income statement and balance sheet in the worksheet to see what's going on, at least as a preview. Okay, so let's look in the worksheet. In the income statement, I need only revenue and expense. That's it, nothing else. Revenue minus expense equals net income. Okay, so let's see where is my revenue here. You see here revenue is starting from 401, right? So let's go. Equals to revenue, enter. Okay, and here I go. Those are expenses. So equals to that expense, enter, equals to that expense, enter, and equals to rent expense, enter. So it looks like below this line, you see that thick line here? Those are all my revenue and the expenses, looks like. So I just copied them in here. And because I used the formula with the fill handle, I put it all the way to the right. Remember that? So using that fill handle, I pulled the formula to the right, and all my boxes now, they have that same formula that they are adding up the whole column. So here the whole column is 63,000, and my expenses are total 34,500. Okay. Now, you go below expense. One more time. You go below total expense. And you say equals to, and then say revenue, whatever it might be, minus total expense, enter. And that is a positive number. That means my revenue was bigger than my expense. Therefore, it's a 28,500 positive number. We call it net income. So either it's net income, if it's in the parentheses, that means it is loss. But in this case, it's income. Very good. But remember, we need to have both sides equal in worksheet when we are working, so we don't make a mistake. Okay, so let's go here, and I say 0 equals to total expense plus net income, enter. Cool. And I do the same thing now. I grab this fill handle, I pull it to the right. So the same formula applies. I-32 plus I-33 equals 63. And both sides are equal, 63 and 63. So there you go, double line, $sign. So I'm good. So it looks like my income statement will be something like this. $63,000 revenue minus few expenses, and I will end up to have a net income of 28,500 on my worksheet. Remember, this is not official income statement. This is just a preview. Okay. Then whatever else is remaining in adjusted trial balance, whatever, just copy it into balance sheet. Simple as that. So here we go. Equals to that box, enter. All right. Equals to that box, enter. Cool. You see what I'm doing? Equals to that box, enter. You see this has a formula like that. I can grab that box and fill handle and pull it down, and everything will be transferred here from this box to this box. But because I don't want those zeros, it might be right now a little bit confusing. So I don't like to do that. It's not a big deal. So let's not be lazy and go to the next box and say equals to that box, enter. But you could have just from here grab the fill handle and pull it down, and everything will be transferred, but the ones that has nothing in it here will show as a 0. That's why at this moment I don't want to do that. But if you have a very busy lineup in here, just do one, grab the fill handle and pull it down, and all this formula will be transferred, same as this box, whatever that formula is, will be transferred to the other boxes, and life is good. So here I have equals to 4,500, enter. It's a credit. So here I go credit equals to this credit equals to that one equals to this, and that's it. Yeah, nothing else. So now watch at the bottom. This is not equal, is it? No. Oops. So now what? This is where you work to make sure that the whole thing you did in here is kind of done properly. So here, see how you check your work. So now watch this carefully. You look at the result of revenue minus expense. It might be net income, it might be net loss. If it's a net income, which is a positive number, as you see, then you transfer that, copy that positive number below smaller number in the balance sheet. One more time. If this is a positive number, which is net income, it's not a net loss, it's net income. Copy that, because it's a positive number, copy that below the smaller number in the worksheet. If that number, it's a negative number, then copy that below the larger balance in the balance sheet. Okay, so but for now, this is a positive number, so I'm gonna copy it below smaller number in the balance sheet, and here we go. Cool? And then I'm gonna go ahead here, you see this one has a formula. I'm gonna grab the fill handle of this box and pull it to the other side. And now, you see 378 plus 28 is 407. 407 plus 0 is 407. 407 is equals to 407. So my balance sheet is balanced. This is how you check your work. If this $28,500 cannot make this both sides equal, then you made a mistake somewhere. This $28,500 should make your balance on the debit side and credit side same thing in the worksheet. As you see, it did it. So my job is good. I didn't make a mistake. Life is good. Here we go. I don't know why this is red, but okay. Any question? No? Okay. So the balance is ready. Now, my accounting team and my management, they look at this. We all have a meeting, and everyone says, fine, everything is fine. Specifically nowadays, if if the companies they want to work remotely, definitely they go through a online meeting, and then they look at this remotely. maybe some managers are in other locations or for some reason. So here we go. Now I'm gonna use these suggested adjustments to do the end of the year actual journal entry, okay? So my suggested adjustment is prepaid rent, $18,000 here, credit, and rent expense debit. Okay, let's go. So go to adjusting entries for December 31st of 2014. If you use a QuickBooks and you want to do the journal entry, there's a box that you have to check that box. By checking that box, you are saying that this is adjusting entry that I'm doing. So imagine this is a QuickBooks, there is the box for adjusting entries, and just I click that box just to show that these are all adjusting entries at the end of the year. Okay, so here we go. I say debit what? Let's remember again, debit what? Rent expense, debit first, credit last, right? So debit rent expense, right? You see that? And credit prepaid rent. Okay, so here we go. Debit rent expense. So if this was QuickBooks again, there's a box in here that where the cross is, and you click that box and the drop down menu will open, chart of account. You choose your account that you like to put as a debit. Here I don't have such a drop down, account, so I just use typing. So, but debit what? Debit how much? Equals to, go to worksheet, click on that box, enter. Got it? Now, the other one is indent. In QuickBooks, you don't need to indent, but here in a classroom environment, we indent just to show that it's a credit. So this is prepaid rent, okay? And credit equals to, go to worksheet, and that's the prepaid rent, and enter. Fine? Good job, huh? Okay, so now that you did the journal entry, what's the next step? Remember that? Save and new, right? Because you want to do another one. So let's save it. That means post it. Okay, let's post it. Post it where? In the T account. So prepaid rent expense, I don't have one. So let's create rent expense. What was the account number for rent expense? Let's go to worksheet. That was 643. So let me, 643, that's the account number. Okay. So rent expense, normal balance for any expense is debit, so equals to, let's look at the debit of my rent expense here. And enter. And all of a sudden, it's right there, and that's the formula, V37. Prepaid rent, I have it right there. It has to be credited, so go to credit, say equals to, and that's a credit right there. Click enter. And now we have prepaid rent. So what's the balance right now in our prepaid rent? The balance in the prepaid rent, so let's draw a line. And say equals to debit side. Asset is always normal balance debit, right? Asset, normal balance debit. The asset minus the credit side, enter, and the balance is 18,000 because this is our final answer. So let's make it like $1, looks better. There you go. Life is good. Okay, so now let's do one more. We have, I believe, few adjustments to do. So let's look at the worksheet. The next adjustment we want to do is accumulated depreciation dash equipment should be credited, and depreciation expense dash equipment should be debited. Okay, so let's go. So depreciation expense dash equipment. So depreciation expense dash equipment. That's a debit, equals to, go to worksheet here. You see it's a debit side. In accounting, debits first and then credit last. Okay, here we go. Debit first. The next one, let's do some indent. It is accumulated depreciation dash equipment. Okay, accumulated depreciation dash equipment. That's the contra account to the equipment. That's where you accumulate all your annual depreciations. So equals to, go to worksheet, and that will be that box. Enter. Okay. And you need now to do what? Post it, right? So click Save and New in QuickBooks, let's say, and post it. Here we have to do it manually. So accumulated depreciation. So let's see. This is my equipment, but I don't have depreciation expense or accumulated depreciation. So let's go. So this is my depreciation expense dash equipment with an account number. I believe it's 168. Oh, depreciation expense? No, depreciation expense is not 168. Let's look. Depreciation expense 612. 612. 612. Okay, so debit depreciation expense equals to, go up, click on that depreciation expense, enter. Okay, and this one is accumulated depreciation dash equipment, right? Dash equipment. with an account number, what was that? 168, I believe. 168. Okay, that's a credit. You see depreciation expense, normal balance is debit, yes, but accumulated depreciation is contra account to equipment. So it's opposite of asset. Asset is debit, this is always credit. Equals to, and then we go up and click on that, enter. Cool. Any question for me? No. Let's go. So far, I have all my balances lined up pretty much. Okay, so no problem in here. I've done 2 adjusting journal entries, and I have 1 more to do. So let's go. The next one, let's look in the worksheet. The next one says debit unearned revenue or deferred revenue for 63,000 and credit revenue. Okay, let's do it. So debit on earned revenue or deferred revenue, and that's a debit, equals to, go to worksheet, get it from your worksheet. You see all those adjustments are coming from worksheet. I'm not typing any of those. None of those are typed. And this one is, let's put some indent, revenue, and it's a credit, equals to, go to worksheet, and that will be a credit of $63,000. Enter. Cool. Okay. So don't forget to post this, save and new. So it's not a QuickBooks, I have to do it manually. So here we go, post, save and new, and then I go down and where is my, here, unearned revenue, do you see that? So it's a debit on unearned revenue, equals to, go up, debit unearned revenue, enter. And credit revenue, okay, and revenue, the balance is 400 something, I believe, 401. Yes. So revenue is account number 401. Okay, and that's a credit, equals to, that box. Cool. So revenue now is $63,000. Unearned revenue, let's calculate the balance. So here we go, equals to, oops, no, this is wrong. Wrong. This side. Why? Because unearned revenue, it's a liability, and credit side is bigger than debit side. So I have to be on the credit side. So let's put a box in it, that one, and then say equals to the credit side, which is a big number, minus the debit side, and the number is $2,000. Voila, that's exactly what we have to have, right? So now everything is looking fantastic, I believe. Okay. So adjustments are done. No more problem on that. What we need to do now is preparing adjusted trial balance, but I don't want to do it because I already can see my adjusted trial balance in here. So it's not necessarily to do that. So I can have this anyway. So, but what we need to definitely to do is preparing what? Financial statements. Yes, I have a preview here, but I need to prepare financial statements, official one. So let's go and here, prepare financial statement. So this is the ABC Inc. income statement, and you have to have a date, let's say for the year ending December 31st, 2000, let's say 14. Right? Okay. So I highlight the area that I want to merge it as in the center, and I click merge and center. Okay. So the first item in the income statement is revenue. So revenue, how much is it? So let's go here, say equals to, okay? And you can now bring this from the T account, or you can bring it from the worksheet, wherever you like to bring it, okay? So you can bring it, let's say, from the worksheet. So my revenue will be equals to that box, or from worksheet. I like to do worksheet is better, so let's do it worksheet. But technically it comes from, in the QuickBooks, it comes from the general ledger. But here I have a worksheet, so let me, because I see everything, so why not? So here, from worksheet, enter. So my revenue is 63,000, coming from either the T account or worksheet, doesn't matter. Okay, but I have some expenses. So we call them, let's say, we have rent expense, utility expense, and depreciation expense. So let's start with depreciation because D starts with A, B, C, D alphabetically. So depreciation expense dash equipment. There you go. So depreciation expense dash equipment. Go to the left. It's not a debit credit issue, but just being a little bit organized. That's all we are doing. So go to the left, organize your expenses. So equals to, and if you look in the worksheet, you see the depreciation expense is right there, enter. But because this is the first number in the column, when I prepare an official report, the first number in the column needs to get a $sign. Okay. The next one is rent expense. Equals to, go to the worksheet. You see that rent expense? right there, 18,000, enter. The next one is utility. Okay, equals to, go to the worksheet, and that's your utility. Okay, so let's draw a line here. Draw a line. Okay, and then the total, is that a thicker line maybe? Okay, better. So this is a line, and now we add them up. We call them total expense. Go to the right. You see, I organize them on the left, and the cute number goes to the right. So the add up is equals to that box plus that box plus next one. Enter. So that's 34.5, which if you look in the worksheet, it is exactly the same thing, 34.5. So 63 minus 34.5 will be net income. This is the simplest income statement I can imagine. Okay. So go here and choose the double line part and say equals to revenue minus total expense. Enter 28.5, double line, and that 28.5, if you look in the worksheet, is exactly the same thing. So my income statement is good to go. Now you need to prepare statements of retained earning. Statements of retained earning, it's a report about retained profit, leftover profit, retained earnings in the company that is left over after paying all expenses, all dividends, everything, whatever is left. Whatever is left is a retained earning, which it can be used for any purpose. Doing more research and development in future, paying more dividends in future, buying more equipment in future. So you can use for whatever you want. Here we go. So this is beginning. Retained earnings. So beginning retained earning is technically, it's a brand new company, right? So beginning retained earning is 0. However, you need to add or deduct, because we have a net income, so we add. Which is equals to this. That's why this is number 2, because you need that net income from here in here. Okay. Okay. And then less dividend. Okay, less dividend. Dividend will reduce your retained earning. Net income is increasing your retained earning. Retained earning will be, it's a source of inside equity that will be increased if you have net income, but it will decrease if you pay dividend. But you like to pay dividend to your shareholders to keep them happy, right? So go to this box, say equals to, either go to, let's say, worksheet, or go to here in the general ledger, which is here, right there, dividend. Enter. There you go. So the dividend will be accounted for in here, and then you can use the double line, which equals to beginning plus net income minus dividend, enter. So 0 plus 28.5 minus 22. So this is and retained earnings. There you go. So the beginning retained earning was 0, and retained earning was 6,500. Okay. Any question? Anyone? Okay. So after the report number 2 is prepared and retained earning and retained earning balance is ready, I need that balance to use it in the balance sheet. So let's prepare the balance sheet now. So for the balance sheet, I need all assets, right? I need all assets. Okay. Balance sheet also, remember balance sheet is, let's merge these few boxes. Balance sheet is a moment in time. So you say as of December 31st, 2014, something like that. Or just put date, December 31st, 2014. Okay, asset is, you start with current asset. Remember in the classified balance sheet, I said you have current asset first, and then investment, and then property, plant, equipment, and then intangibles. So let's go with current asset. Current asset, the most liquid one is cash. So let's say cash, right? And I can get it from here or again from the worksheet, doesn't matter. So let's say this time I get it from here so you can see that. So I go to cash right here, and I say equals to that cash balance that you see, 390. Cool. The next one I have as an asset is equipment is an asset, but it's PP&D. PP&D is later on. So prepaid rent is a current asset. So let's go prepaid rent. Prepaid rent is a current asset. Current asset is an asset that can be converted to cash in 1 year or less. So here we go, current asset equals to, go to prepaid rent. What's the balance here? You see 18,000, enter. But because this is the second number, I don't need $sign anymore. So I'm gonna make this just general number. Cool. Just keep it simple. Okay. So prepaid rent. What else I want? Any more assets? Let's look at it. Any more assets? This is accumulated expense revenue. Okay, let's go to equipment. So there is no more current asset. There is no investment. Investment goes next. So you skip that. So the next one is PP&E, which is equipment in this case. So equipment. And that will be, because equipment needs to be calculated a little bit. So let's calculate that. So equals to that amount, enter. And this is the first number in the line. So I need a dollar sign right there. Okay. And this one is accumulated depreciation dash equipment. So accumulated depreciation equipment is a contra account to equipment. So it's equals to, and that's right here. So you see now this part is done. I would like to put a line below this, not double line, but just bottom tick line maybe, that it's visible here. Okay, so you can see it, you know, it's a line. So here you call it net equipment equals to 48 minus accumulated depreciation so far as of this moment of 4,500. So the net equipment is 43,500. Why is it so important to know what your net equipment is? Because let's say I sell this equipment right now for $44,000. So the $500 extra above net equipment book value, that will be a gain on sale of equipment. But let's say I sell it for $40,000 right now today. So because the book value is 43,500, but I'm selling for 40, so I will have a loss on sale of equipment for $43,500. So it's very important to have a book value on your equipment, because if you sell it, then you need to recognize a gain or loss because of sale of that equipment. Okay, so that's about it, I believe. So total asset is, let's put that double line, equals to, or you can use sum. Let's use sum so you can kind of see that. So here, auto sum, and then go up from starting from the top, click your mouse and keep that click up to where you want, right there. Let it go and click enter. So here we go. So that's a sum formula, okay? So I have a total asset of 380,500. Okay. What else? Now we have liability. What do we have as liabilities? Okay, liability, I have, let's look. I have unearned revenue 2,000 and dividend payable 22,000. Okay, so let's go. unearned revenue or deferred revenue equals to that box 2000 and needs a dollar sign. Why? Because this is a new section now. I finished this double line dollar sign. So that's one top. Sometimes balance sheet can be next to each other. Here I put under each other. So unearned revenue 2000 and dividend payable, and that's equals to where was that? Here, dividend payable, enter. Cool. So in that case, that will be all. There is no more liabilities. Okay, so let's draw a line. Maybe a tick line so you can see it like that. And that will be equals to 2000 plus 22,000, enter. That's 24,000 liabilities. We call it total liability. Okay, and the other one is the equity. So equity, I have common stock. Common stock. And that will be equals to, I'm running out of space a little bit. Okay, let me, because I'm not gonna print this, so I can't do it. For you, because I was printing, trying to make sure it fits in one paper, one side of a paper. So I gave you less room, but here I can add room, so it's okay. So here we go, I say equals to, and that is common stock here, that box, enter. Doesn't need the dollar sign, okay? We have a dollar sign here. Dividend payable doesn't need a dollar sign. So that's not, doesn't need a dollar sign. So just $1 sign here, $1 sign there is fine for two columns, okay? So common stock, and the other one is retained earnings, and that is equals to, and that is retained earnings, and retained earnings coming from here. You see that? That's why this is number 3, because I need number 2 to take care of number 3. So I have number 2 to take care of number 3. Here we go. My number 3 balance sheet is now completed. So let's draw a tick line here too. And then go here and say equals to 350 plus 6,500, enter. This is total equity. Let me do this way so you kind of, okay. Total liability and equity. Okay, I can do this. I'm gonna delete this. There's another way to do it. So here you draw a line, you see there's a line, and then you go next to it, you say equals to that box plus 6,500, enter. And now I draw a tick line here too. Okay, and the double line there. Okay, and now This is total liability plus equity, which is 24 plus 356 equals to 24 plus 356.5, enter. And there you go. Life is good. So 380, let me highlight it for you kind of here. Fine. You see that? That one and that one. Okay. So here we go. So retainer income statement, we have a net income of 28,500. Retained earning, we have 6,500 at the end. That 6,500 at the end comes to number 2. The 28,500 income statement, net income, goes in number 2. And from number 2, we get 6,500 goes to number 3, which is right there. And then our balance sheet is prepared. Assets first, liquid asset at the top. There's no investment. The next one is PP&E, which is equipment. And then there's no intangibles, and that's about it. So that's all my total asset after the 380,500. And that's my liabilities. And that's my common stock.